Hello and welcome to Insurance Mantra, your weekly guide to the world of insurance, only on ET Now. In today's Leadership Insight, we focus on motor insurance, one of the India's most widely purchased yet least understood insurance product. From third-party coverage to comprehensive coverage to EV insurance, digital claims, AI, and the future of motor insurance will answer the every question which vehicle owner should know. To discuss this, I am joined by very special guest today, Animesh Kumar Das, Managing Director and CEO of ACKO General Insurance. Animesh, welcome to Insurance Mantra.
Thanks, Anurag. It's my privilege to join you over here.
So, Animesh, the latest one, I'll start with the latest one, only the recent judgment of Supreme Court where for the new private car, third-party insurance should be of 4 years, and for two-wheeler, it should be of 6 years. What's your take? How this will help in reducing the number of uninsured vehicles?
Yeah, so I think the recent Supreme Court order covered two aspects. One you mentioned, which is making the policy tenure for car and two-wheeler respectively 4 and 6 years, which was 3 and 5 years before. And the other is the integrated enforcement, where let's say integrating challans with uninsured vehicle database or doing a pilot with the petrol or the fuel pumps to figure out who has insurance, who doesn't have insurance, and accordingly see if the fuel can be given to them. I think directionally the thought is correct. The idea is to kind of reduce the number of uninsured vehicle on the ground, but I think the long-term third-party cover solves the wrong problem. This is applicable for newer vehicles, and newer vehicles, as you are already aware, that they have higher penetration of insurance. They are already compliant. So I think it's not solving the right problem statement. The major issue is with the commercial vehicle. Commercial vehicles have more than 55-60% of the claims, TP claims, and the older vehicles. Older vehicles do not renew their insurance or they are non-compliant. I think that's not what this order is solving. So that's the major gap or the major issue. It has one unintended consequence, which we have seen in the past also, which is now the newer vehicle segment is transacted through the dealerships or the OEMs, and there the pricing is already higher. The commission component is also higher. So the customer base or the vehicle owners who were already compliant now will be penalized more. So that's another issue. So we need to see how will this play out. This is actually very tricky and may not be solving the right problem. So we need to see.
Expect, Animesh, you are...
I think
help us understand this, the newer vehicle aspect through the dealer means how they will be penalized because I could not understand this.
See, what happens today as a consumer, if I go and buy a brand new car, I'm just taking a very simple example, let's say a car which is 10, 12 lakh or 12, 15 lakh range, a Tata Nexon or something. The insurance component is what the dealers end up charging is in range of 60-70,000 rupees. The true price, which is out, like the true risk price, may be in range of 20-25,000 rupees. Now, there's a built-in commission component out there. Now, given the customer is buying a car, it's a captive customer of the dealership. So dealerships have more leverage, more power to charge higher commission. And that commission is obviously baked into the pricing itself. So the customer ends up giving higher premium. And now with 4-year tenure or a 6-year tenure in two-wheeler, this power will be more like the dealers are more empowered to charge higher commission. First of all, that 4-year premium itself will be higher. The dealer is locking in the customer for 4 years, so that gives more power. The insurance companies they'll be able to charge more commission from the insurance company, and that's where the ticket size will go up. So I think this segment, I'm just taking car as an example, for first 4 or 5 years, customers were anyways buying insurance, 80-85% plus customers were anyways compliant. So that customer is not just paying higher commission or rather powering higher commission through their ticket size. So that's the problem, which I think industry has seen in the past, and that problem will continue with the kind of decision or the order that has come up.
Okay, but how insurance companies would be able to price the TP premium for 4 years and 6 years? Don't you think that will be a big challenge to price a premium for next 6 years or for next 4 years?
Yeah, it's a genuine challenge. I think nowhere outside India there is a third party or motor policy of multi-year tenure. So there are three issues. One is the way the current pricing works doesn't take into account the inflation that will happen in 4 years or 6 years down the line. So that's one issue. As we are already aware that the prices are anyways not revised for some time now. So there's anyways pressure on the insurance company with respect to TP pricing. There are a lot of other market forces which play out. So one of the recent one where there have been again Supreme Court order where the claim settlement expected in TP has also gone up. So these kind of market forces also play out, which is not accounted today. So it's very tough. It's actually tough to kind of price for next 4 to 6 years. So that also puts pressure on the insurance companies to correctly price. And like I said, on top of it, there is a commission which will be baked into this.
And Animesh, for most of the insurers, TP is a loss-making business only, or few are making money also from TP business. And how affordability in TP business can be balanced with the customer satisfaction also?
Yeah, so like you said, I think the TP premiums haven't been revised for good time now. So I divide this into three components. Commercial vehicle, I think across geographies are like they are acutely stressed in terms of pricing. So most of the companies may be making losses in commercial vehicle segments. So that's one issue. In certain segments, private car or two-wheeler in certain pockets, few geographies, there's some margin cushion. So that is still balancing the portfolio for the companies. So yes, there is a clear challenge as far as the economic goes from a TP pricing point of view that is expected. It is recommended that segment-wise pricing review should be done. Which segment is under pressure? There should be some pricing revision. On top of it, I think there is one more important outflow. Typically, in motor third party, it's not expected that the insurance company should pay out much commissions because it's a mandated product. But there are high commission, as we know in the market. Also, there are component or there are geographies where there's higher commission. As we are aware that there is a commission reform which is expected. If that caps the commission to some extent, there'll be a breather, possibly a breather. But at a large level, a, a TP price calibration is needed, majorly needed, and the way the inflation is TP price and TP claims inflation is happening, I think the industry is under pressure on that front.
Just said that distribution reforms expected, and very soon IRD is all set to come up with a new discussion paper. So what are your expectations? Because IRD chairman has spoken about effort-based commission, different commission for the different products. So what are your expectations and what advice you will give to regulator on the commission front, on the distribution reform front?
Yeah, so I think whatever we have heard about it, because there's nothing officially communicated yet. So whatever is available in the market, our understanding is that most of the pointers are in the right direction, making the commission component linked to effort, linked to renewal persistency, and there are different segments. Effort means like obviously if there's an agent, individual agent who's putting more effort to kind of advise the user to buy insurance, the commission can be higher. If there's a captive customer base where the original transaction that customer is doing with the channel or the partner is for some other product like dealer, customer is buying a car over there. So it's a captive customer base, and that's where the insurance effort to sell insurance over there is lower. So the commission should also be lower. I think these ideas are in the right direction. So we also fully support the regulators' view or the or the way they are designing the commission reform. We still have to officially hear that what exactly will the commission reforms cover. But our suggestion is that this will be a good reset for the industry. Commission is one of the component we believe, specifically as ACKO, we believe that this is a challenge which is squeezing the insurance companies, and they're not able to invest into the customer experience or building capability around customer experience. So I think if this gets solved, the companies can focus a lot on how they can solve the consumer experience and make the product more and more affordable, which will, I think, solve a lot of these under insurance or under penetrated insurance segments as well.
In motor insurance or in general insurance, products are sold through agents, through bank channels, through web portals. So do you think that in general insurance also commissions can be linked to the persistency, the customer service, which will give a better experience to policyholder?
Absolutely. I think, see, it's a simple question. Like, why should a customer pay commission, right? Or pay for the commission, right? So one is the channel is bringing in the advisory value, which includes you're supporting the customer to take the right product selection. You are supporting the customer at the time of claim, or you are ensuring that the customer is taking the right coverage. They are correctly insured, not over-insured, not under-insured. So these are the services, or these are the value add which any intermediary or a channel is bringing in. Now, if I'm just taking a simple example, if a customer has selected the right product and they're happy with the coverage, they'll renew the product or the selection year on year. If they are happy with the claim service, they will continue to buy that product or stay with the product, right? So these are the metrics which actually signifies where the intermediary have done their part of the job or not, and that's where their commission should be linked or their incentive should be linked. It should not be that once you force the customer to buy a product, you make all your commission money, and that the customer is not happy with the product, they are not renewing the product, or they are not getting the right service at the time of claim or after sales services. So you're differing the value add which you are bringing into the customer's life cycle. So I think that is critical, that all these metrics should be linked to how the commission is paid out, so that the intermediary is there doing their part of the job correctly.
How much the variation is there from one company to another company for a same car insurance? If I'm going through insurance given by the dealer and against the insurance from a platform direct to customer platform, how much is the variation?
If I take the same example which we're discussing, let's take Tata Nexon or a Hyundai Venue or 10-15 lakh segment car. If a customer goes to a dealer, they may end up paying almost like 60,000-70,000 rupees for that insurance. If they go direct, they'll get a premium of around 25,000-30,000 rupees or 20,000-25,000 rupees. So this is a delta of almost like a 30 to 40,000 rupees. Which is
it covers both
commission.
own damage or third party both?
Yeah, I'm saying same to same coverage. So I'm counting third party for 3 years, which is mandated for 3 years in a brand new vehicle or brand new car scenario, and an OD which covers few of the right add-ons, like for example, zero depreciation, consumable, and few other add-ons. So if you compare these, like apple to apple, compare these products, there can be almost like a 2x delta in terms of premium. And the simple thing is the commission is, in worst cases, as high as 50% also in few of the pockets. So that's the delta, that's the difference which customer ends up paying. And like I said, in my opinion, because what you're effectively doing as an intermediary is just suggesting the customer that which product to buy, which motor insurance, which is as a segment or as a line of segment, is actually not as complex. So there, the customer, I don't think so there's a value add that any intermediary or a dealer is bringing in where they can charge 2x the true price of the product. So that's I think, a big gap. And like I said, that original point which you're discussing, the Honorable Supreme Court order is further giving more leverage to these kind of channels to even charge higher. and lock in the customer for 4 years, where there's no portability or cancellation process which is solved in the industry. So I think that will add to the whole challenge.
Okay. And now I want to understand you from you, Animesh, how EV insurance is evolving, because we are seeing the data that electronic vehicles are increasing month on month basis. So how EV insurance is different from the conventional motor insurance, and for EV vehicles, how premium is different from normal private cars?
Yeah, so I think fundamentally EV, from a usage pattern point of view, EV vehicles, from a usage pattern point of view, or risk profile or the cost drivers are structurally very different from the ICE vehicles. Sadly, the current insurance products which are out there in the market today are very similar to what you get in an ICE vehicle. So there are a lot of components, especially battery, in an EV vehicle, which is a very different kind of risk. There are components which are 100% not covered in insurance. For example, batteries, the bigger issue of the battery is the degradation of the battery, or the performance of the battery keeps going down every year. So there is a need beyond insurance, like battery warranty or extended warranty sort of coverage. How can you cover a damage which is specifically in the battery? There are components like display components and few other components which are linked to battery, but not covered. Again, not covered because the way the product is designed is as per the ICE vehicles. So I think those are the gaps in the industry today. Fortunately, ACKO has been one of the companies who have invested into this ecosystem, and we have one of the performance-based battery warranty product where we are working with few of the partners to offer this to our consumers. So these are the kind of innovation where the insurance companies have to invest into research and understand what kind of product will make sense. But yes, sadly today, given the risk profile and the usage pattern, there is a gap in terms of the kind of insurance which is offered to the EV vehicles.
Time for a short break. Don't go anywhere. We'll be right back. Stay tuned to ET Now. Welcome back. After the break, we continue our conversation with Animesh Das, Managing Director and CEO of ACKO General Insurance. Going ahead, we'll see more and more innovation also in EV insurance, and what kind of innovation it can be.
So yes, 100%. I think the government is also very aggressive in terms of how customers can adopt more and more electric vehicles. They like, and I'm sure you have tracked the same thing, that in certain geographies with certain timelines, they have mandated electric vehicles, and they are kind of banning the older ICE vehicles. Like in Delhi, two-wheelers, they have applied the same logic. They have also applied the same logic for the tenure of the vehicles also. Slowly, the older vehicles or the diesel vehicles are being moved out of the market, right? So those things are pushing more and more electric vehicle adoption, which again makes the electric vehicle a larger component, a larger share of the market, which will push the insurance company to further innovate. There's one more good thing which is happening. I think one of the component in battery, not just from an insurance point of view, even from a banking world or a loan world, is the risk of identifying the batteries as well, because there are certain vehicle segments where the battery swapping is also possible. So identifying the battery is very critical to understand the risk. And there are a few reforms which are work in progress, where battery Aadhaar is work in progress. So if you identify the battery correctly, if you offer the right product, and if you can mitigate those risks, then you can make electric vehicle more and more affordable for adoption, which will fuel the whole growth in terms of investing more and more into the electric vehicle ecosystem, both from a financial product solution and also from a product innovation. So I think it's working out in the right direction. I think everyone has to invest into this ecosystem. It'll not give result right away, but people have to invest, keeping the long-term mindset in their thought process.
Okay. Animesh, we have seen that in last 2-3 years, there are a lot of other innovations also in motor insurance segment, like pay as you drive, telematics. So how these innovations are picking up is policyholders are accepting it. There are more number of policyholders going for pay as you drive, or still more need to be done on this front?
I feel there are two components to it. Like one is pay as you drive can be diluted as a gimmicky product also at the same time. So, end of the day, the customer should see very strong value in the product or the construct they are buying. If it's a simple conditional product where the customer is not seeing any upside in terms of coverage or affordability benefit and all, anyways, the pricing are also very, very aggressive in the market without actually meaningfully changing or without meaningfully solving for the economics of the insurance space. So the challenge which it leads to is that the insurance companies are not able to invest into the customer experience or the way the claims are being settled. I think because of this, uh, there is a gap in terms of how these products are designed and how these products are explained to the users. So it needs a slightly more uh, well connected, well integrated product in mind in the way it is designed and delivered to the consumers. So that's why there's a blocker, the adoption is slow. I feel that first two component to solve is how can insurance company invest into the customer experience where the customers start trusting the brand, start trusting the product itself. You make the product unconditional in a way, make it more meaningful for the consumer. After that, if the pay as you go or any other construct helps user to reduce their ticket size or get more value out of the same product design, then it makes sense. But I think this is a two-step process. The first step is still pending. Like I said, we are looking forward for the commission reform, which hopefully will solve for some economics or sustainability for the insurance space. Then the insurance company can invest more into the right innovation.
Okay, Animesh, my final question for today's insurance mantra. As per your experience, what are the main mistakes of policyholders while buying a motor insurance? Or on the other side, if you had to give three suggestions for vehicle owners for buying a motor insurance policy, what should be the checklist so at the time of claim they should not have any surprises?
Like I'll cover a couple of aspects from a claim point of view also, but I think one is which is under process anyways. You need to figure out whether you are paying for the right price or not. So most of the time, most of the insurance companies' online website at the right price. It's good to kind of check that price, and whoever your agent or a dealer or whoever wherever you are buying a product from, it's always good to question whether the premium which you are being which you will end up paying, is that correct or not? What is the value add that transaction is bringing to you, right? Because otherwise you end up paying almost 2x the price, but doesn't make sense. So that's one. But at the time of claim, which is I think is more critical, is honestly my belief is that customers should not be worried about anything at the time of claim. It should always be at the time of buying the product, because it's insurance company's duty to make sure that the claim process is as smooth as possible. But the right thing to do is obviously declare the right, be truthful about the product, be truthful about the declaration which you're doing. I think it solves for a lot of pieces. Reach out to the insurance company first at the time of claim, because that gives them power to kind of handle the claim settlement.
Okay. Okay, thank you, Animesh, for joining us on Insurance Mantra and sharing your insights on motor insurance. Thank you so much for your time and insight.
Thank you, Ananda.
So that's a wrap on this edition of Insurance Mantra, but we'll leave you with our Did You Know? So did you know that to reduce the number of uninsured vehicles on Indian roads, recently Supreme Court has mandated long-term third-party motor insurance. So 4 years for new cars and 6 years for new two-wheelers at the time of purchase only. At the same time, a no insurance, no fuel pilot project has also been proposed in some states to encourage vehicle owners to renew their insurance on time. Driving without valid insurance is illegal and can lead to penalties and financial risk after an accident. So stay informed, stay protected. That's our insurance mantra. Insurance Mantra is now open for your queries and your questions. Just scan the QR code flashing on your screen and send us your insurance related queries. We will get them answered by some of the best insurance experts in the industry.